So from December 2015, just using the averages, not anything crazy, 10 and a half years up, 1,500%, bingo, puts you at $15,000 an ounce in 2025. And by the way, don't wait. If you agree with that analysis and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024, I'll catch the wave. No, it's a long way between here and 1,500. I mean, you got to get to 3,000, 4,000, 5,000, 6,000, 7,000, et cetera. You got a long way to go to 15,000. So why not get the gold now, which I do recommend, and then enjoy all those profits. Don't wait to the end, because it could happen. There could be like a little spike at the end.
Mark this date, December 16th, 2015. According to financial expert Jim Rickards, this date marks the beginning of the third bull market for gold. Rickards predicts that by 2025, gold will reach an astonishing $15,000 an ounce. This bold forecast isn't based on mere speculation. It's backed by solid data and thorough analysis. The first gold bull market saw prices surge over 2,000%, while the second experienced nearly a 700% increase. By averaging these gains, Rickards forecasts a remarkable 1,400% rise, pushing gold to $15,000 an ounce. Moreover, when analyzing the global money supply and official gold reserves, he arrives at a similar figure, reinforcing his prediction. This convergence of independent methods strengthens the case for a significant increase in gold's value. Don't wait until 2025. Take action now and consider investing early to maximize potential gains.
Why is gold going up? What's going on? What's the basis for predicting $15,000 an ounce by 2025, which I do? But then also, what does it really mean? Is that you said it's not a good thing, and I agree. It's not a good thing for the economy. It's not a good thing for most Americans. If you have gold, you can pat yourself on the back and say, yeah, I made a lot of money on gold, but that might be in a world where you're losing a lot of money on other things, and you need to be alert to the overall economic picture. So let's take this one at a time. The gold $15,000 an ounce, it comes out of three different analyses that actually don't correlate to each other. In other words, you do it one way, you get a number, you do it another way, you get a number, you do it a third way, you get a number. It was interesting that they all came out not exactly to the penny, but very close to that $15,000 number. So the first way to do it is just, it's a little bit of technical analysis, not overly technical. We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history is a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. And that was the money. And you thought about it by weight. You say, well, I'll give you an ounce of gold for this property, or I'll give you, a quarter ounce for, some food or groceries or whatever. So you thought about gold by weight. It was money, constant store of value. So it's really only since 1971, when Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market, and still does. The first great bull market was 1971 to 1980, and gold went up over 2,000%, from $35 an ounce to $800 an ounce in January 1980. Then there was like a long, drawn-out, almost 20-year bear market from 1980 to 1999, and gold dropped down to around 250. So it went from the 800 level down to 250. The second great bull market was from 1999 to 2011. August 2011, gold went from $250 an ounce to $1,900 an ounce. That was an almost 700% gain. Then the second bear market, August 2011 to December 2015. The third bull market, I can give you the exact date, December 16th, 2015. Gold hit $1,050 an ounce. That was the bottom of the second bear market I described, a pretty steep fall from the 1900 level. But you could tell it was the bottom. You say, well, how do you know that? I had a conversation with our friend Jim Rogers, one of the greatest traders in general, and certainly one of the greatest commodity traders of all time. And this was before that market bottom, when it was still going down. And I said, Jim, we were down in the Dominican Republic. I said, Jim, you buying gold? And he said, no. He said, I've got gold. I'm keeping the gold I have. I'm not buying more right now because it hasn't hit bottom. And then he gave me one of the best pieces of advice I've ever had. He said, Jim, nothing goes from here to the moon without a 50% drawdown along the way. It'll get there, but it'll go up, down 50%, and then back up for the really big, sort of hyperbolic price move. We said you have to expect that. It's true of all commodities. Well, taking that advice, I then looked at the charts. Well, starting 1900, if you say, okay, it was 250, it was 1999. 1900 was August 2011. So there was that gain. 250 to 1900. So there was that gain of $1,650 an ounce of gain. Take half of that, that's 825. So take 1900 minus 825, and guess where you come out? You come out right at 1075. And so when I saw 1050, I said, bingo, there's the 50% drawdown. It's exactly what Jim Rogers said would happen. That's the bottom. And it's up about 50% from there. Now, it's been a little bit higher than that, but it's up about 50% from there. So there's your third bull market. But here's the point, Robert. If the first bull market was up 2,000% and the second bull market was up 700%, if you just take the average of those two, you don't have to pick the higher of the two. You don't have to go crazy or say it'll be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from where from the 1050. Well, that would put you at almost $15,000 an ounce. So in other words, and the same time period, the first bull market was 8 years, 9 years. The second bull market was 12 years. Just take the average, you get 10 and a half years. So from December 2015, just using the averages, not anything crazy, 10 and a half years up, 1,500%, bingo, it puts you at $15,000 an ounce in 2025. And by the way, don't wait. If you agree with that analysis, and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024, I'll catch the wave. No, it's a long way between here and 1,500. I mean, you got to get to 3,000, 4,000, 5,000, 6,000. 7,000, etc. You got a long way to go to 15,000. So why not get the gold now, which I do recommend, and then enjoy all those profits? Don't wait to the end, because it could happen. There could be like a little spike at the end. So
by the way, gold's approximately with premium about 2,000 an ounce.
Correct.
So it sounds expensive today, but at 2025, you're going to say I should have bought it in 2020.
Yeah, I should have bought it in 2015, but that's okay. Most of the gains are yet to come. The other thing that people don't understand, Robert, is just this is sixth grade math. You don't need calculus for this. Each $1,000 gain is $1,000 gain. If you have an ounce of gold and it goes up $1,000 an ounce, you just made $1,000. That's real money. But because you're working off a higher base, each $1,000 gain is a smaller percentage than the one before. So when you move from $2,000 to $3,000 an ounce, that's a 50% gain. But when you move from 14,000 to 15,000, it's only a 7% gain. So that's why these bull markets get a lot of their gains toward the end, because 7%, that's a week. And then you might have to wait a while to get to 3,000, but if you're at 14, you're not going to wait long to get to 15. A 7% could be a 1 week rally. So in other words, those $1,000 increments are smaller percentages and easier to achieve the further along you go. One more reason to get the gold now.
So that's why you've talked about it. It goes parabolic. It goes.
Correct. But again, $1,000 is $1,000. It's the same amount of money, but it's a smaller percentage, which means it's easier to hit. And so the hard work is right now kind of getting to 3,000, 4,000, which it will. But it can really take off from there. $100 days are going to be the norm. $1,000 weeks are not going to be unusual, and they'll be more and more frequent as we move along. So that's one analysis. The second analysis is if you just use a monetary analysis. I'm not saying we're going to go on a gold standard. We may. Right now, there's not a central bank in the world that wants a gold standard. Not one. They hate it. But they may be forced to go to it or something like it, because if confidence is lost in government money and fiat money, they may have to turn to gold, not because they want to, but because they have to restore confidence. So what's that math? Well, the global money supply is about, I'm using M1 and the major economies, which is about 80% of global GDP, is about 33 trillion. And there happen to be about 34,000 tons of official gold. That's not all the gold in the world. That's the official gold held by central banks and so forth. Well, you just do the division. Okay, divide the 33. Take the 33 trillion, and just say you need 40% backing. Some people would say 100%, but historically 40% has worked pretty well. So you need about 12 or 13 trillion dollars worth of gold to back up that money. Well, if you have 34,000 tons and you need about $13 trillion of gold to back up the money supply, what does that come to? We'll just divide by one by the other, and again, you get a number close to $14,000 an ounce. So there are two completely independent methods. One is the technical historical look. The other one is a monetary look based on money supply. But interestingly, they come out in the same place. And then there are other ways of getting to the same answer. So that's I feel very strong. I feel it's a very solid kind of analysis to get to that number. But the other part of your question, Robert, is okay. What does it mean? Isn't this great? Well, gold's going up. I'm making a lot of money. Well, maybe you are, and other people are who have gold, and I certainly recommend it. But to me, the price of gold never changes. I think of gold by weight. You have an ounce, you have a kilo, you have a ton, you have a 400-ounce bar, whatever you may have. If the dollar price of gold is going up, what's really happening is that the value of the dollar is going down. Because gold is a constant store of value. So if all of a sudden, if $2,000 gets me an ounce, but we get to a world where it takes $5,000 to get me an ounce, what happened? The value of the dollar went down. I need 2.5 times more dollars to get the same ounce. So a high dollar price of gold is again, good for gold holders, but not close for celebration because it means the complete and utter collapse of the US dollar. That's what happened in the 70s, and that's what's happening now.